So today I'm going to talk about 4 new UK stocks I bought recently, and this is quite a big move for me. To buy 4 brand new stocks is obviously quite a big change, and I think the reason why I potentially made such an aggressive change is because I've had a bit of a swap around in the portfolio recently, and the kind of catalyst for that is that I sold out of 2 US stocks, which was Lovesac and Tesla. Sold them both for very good profits, and I was very quickly sitting on quite a heavy cash balance. So that was one of the reasons why that was kind of created. I wanted to spend the cash. I looked at the UK market. For me at the moment, I'm actually seeing quite good opportunity in the UK side of it. You know, the US has had a pretty decent rally since the start of this year, whereas the UK market has been a little bit choppy. Maybe there's a couple of reasons with that. Maybe it's maybe overhanging inflation, but there seems to be some good UK stocks at good valuations at the moment. So I think that played into it. And I think the third factor is that I've kind of neglected the UK side of it recently. I think really, if you look in the last year, I don't think I'm trying to think top of my head, but as far as I can remember, I don't think I've bought a new company into the UK portfolio for nearly a year, which is quite well. And obviously I built up a good UK portfolio through that 2020-2021 period and maybe into the start of 2022, but I've not really bought anything else into it. And I felt like I was neglecting it a little bit, and I thought there was some good opportunities out there. So I thought, you know what? Let's go add some of these stocks into the portfolio. And these are 4 stocks that I thought, these are interesting levels to buy. I'll buy a couple of shares here and we'll see where we're at in a few months and maybe build them up into good positions. And I think the combination as well of that, when you look at the US side of it, in the last 12 months, we've had the last 12 months on the US side of it where we were actually having good sales on stocks. Like you had the likes of Google, the likes of PayPal, the likes of like Mercado Libre. You had them sort of companies taking an absolute nosedive in 2022, and we've not had the likes of the big tech, like the really big giants that are very high quality companies. We have not had them on sale since like 2020. So it was like 2 years since we last had a good opportunity to buy the big tech out there. And I think that's probably why I was capitalizing a lot more on that in 2022. And I kind of like didn't touch the UK side of it. And now looking at that, you know, them opportunities have obviously developed. When you look at a lot of the big tech, for example, there's been a bit of a rally going on there now recently, and kind of not put as much attention into this. And I thought, okay, here are some opportunities to go buy out there, and they do look very interesting. So we'll get started on these stocks. It's a good mixture of stocks, so I hope you enjoy it. And as always, for me providing this information for totally free on the internet, all I ask is can you please smash that like button, and we'll get started. And as always, if you want to know what I'm buying and selling in real time, join through the Patreon. You get 2 exclusive videos a week on there. I'll drop the earnings review very soon on the Patreon, and you get to know what I'm buying and selling in real time on there. So I bought these stocks, I think it was either 2 or 3 weeks ago. So you guys on the Patreon obviously know that I bought these a little bit ago, but we'll get started onto these 4 stocks. So the first one is Moonpig. It's currently £1.30 and it's a 438 million market cap. So that's a pretty decent size for a UK company. And you can see here it trades at 21 times earnings. Now, if you have a look at Moonpig, it IPO'd in 2021. Obviously the hot time for IPOs in that period of time, and it actually did okay when it came onto the market for the first couple of weeks, and then since around 2021 the stock has been on a massive decline, and it actually hit a 52-week low of £1.2p. Since then it has had a bit of a rally since that time frame, and the stock is up slightly. And if you actually zoom into 1 month chart, you'll be able to see this here. Personally for me, I'm currently up around 15% or something on this stock, which is good that I'm up on this position since buying it, but I would have liked it to stay maybe a bit lower to buy a bit more. We'll see how that does develop, but it trades at 21 times earnings, so we do know it's profitable. And obviously that P looks probably about average, so we have to adjust to what kind of growth are we getting here, because obviously if it's 21 times earnings and there's low growth, you're looking at a pretty rich valuation. If it's 21 times earnings and you're getting a massively growing company, obviously it could be a cheap valuation, but we know they're profitable at the moment. So first of all, why is the share price on a big decline for the last year and a half? Well, after its IPO and its shares did very well, unfortunately it was a bit of a rich valuation, and we saw in 2022 a lot of valuations compress. Now, a lot of people don't actually understand this and why share prices move a lot. quite often the share prices on a company actually don't move because revenue and profit grows. Obviously, that is a big factor. You know, if a company does grow its profit and revenue over a long period of time, it will be reflected on the share price. But one of the big movers of an actual share price will be metrics expansion and contraction. So, for example, an example that would be like price to earnings. If we're in a bull market, a lot of companies will trade at a richer valuation. So, for example, Moonpig could be trading at 30 times earnings. Because it's trading at 30 times earnings, that will obviously lead the share price to go up a lot. If there's a contraction, a bear market, a lot of valuations get compressed. Moonpig goes down to 20 times earnings, and that causes a lot of the share price to go down. And quite often, one of the big things of share price movements, as well as the profit and revenue growth, can be just if we're in a bull market or bear market, and can it be one extreme on the metric expansion or compression. And that's what happened with a lot of stocks in 2021. A lot of them came in at very high metrics. And then what we saw in 2022 is because we had a bear market, all the stocks went to very low metrics, and that's what's caused a devastation in a lot of stocks, for example. And ultimately, what everyone's trying to work out now is, has the stock reversed to a realistic metric, or have some of them gone too low? And that's ultimately what a lot of people are trying to work out. The other thing that Moonpig had is it had a massive expansion in growth. So previously this company has performed very well. It's grown revenue at really good rates, it's grown profit at really good rates, and it's held very good profit margins. 17% profit margins is a very good amount of profit to be throwing off. But what happened in 2020? Stocks, online companies, the CV situation, everyone went online. All the online stocks went absolutely crazy, and they had a lot of demand pulled forward. Moonpig was exactly the same. You can see here, April 2020, the company was sitting on 173 million. By the time we got to mid-2021, the stock had gone to 368 million. So that was a massive jump up in the revenue, as you can see here. Now, the big thing is that what this caused is a lot of companies to have a lot of demand pulled forward. And then ultimately, when we got to around 2022, a lot of their kind of offline business came back, and a lot of people went back to the high street. And you can see here, that's what's happened with Moonpig in the last years. It's had the kind of calm down from the CV situation, but it's ultimately important to look that it still held on to a lot of the revenue from that time frame. And that's where we saw companies like Card Factory, for example, another stock that I own, is a company that did really well, because as soon as the high street came back, boom, the share price went absolutely crazy, and it's a stock that we're up over 115% or something on right now. So even though Moonpig has suffered, Card Factory benefited from it and did really well. And now it's going to the other way now, where you're looking, okay, now the online suffered because everyone went back to the high street. Has the hard comps and the demand that's being pulled forward starting to get resolved? And as well as that, the big thing is you'll see also the profitability has had a bit of a dive as well going forward. So for example, right now we're looking at 21 million in profit, nearly 22 million in profit. You can look at the CV situation, it's lower than where it was basically to the CV situation, and obviously the revenues boomed. So we want to see the previous profit margins start coming back, and that is forecast to start coming back going forward. And you can see here in 2024, analysts are forecasting nearly 36 million in profit, which then would put you somewhere around 12 times earnings for this business, which does then look a lot cheaper going forward. Now, Moonpig itself is an online retailer for cards, and it has moved more into the gift section as well. And this is a pretty big growing area. At the moment, you can see here, there was 57 billion spent on gifts in the markets in 2019. And they currently have 68% of the UK market for online cards in 2021. And in Netherlands, which they have the company Greets, has 67%. And the online currently makes up 16% and 20% in the Netherlands. And I think the online space will only continue to grow. A lot of the younger generation prefer to do ordering online rather than going in person. And there's still a lot of market to go. And one of the big reasons why Moonpig has had very good sales going forward is it's actually got a repeat business. So if you look here, 80% of their revenue in the year ending 30th of April, 87% of it came from existing customers. So basically people come on and order from Moonpig, and then once again, when someone's birthday comes around or they need cards again, they go back onto Moonpig to reorder. So that's really good that you've got that strong of a repeat business or customer base coming back in. And this helps through like reminders of it's someone's birthday. this is a design that we've already made for you, do you want to order it? And that's very good. It's a bit more like a kind of a SaaS model for an online card business, which is unheard of, and that's probably why the growth has done very well. And they've also completed the purchase of Buy a Gift, so ultimately expanding into the gifting part as well, and trying to upsell where people are buying cards, but potentially you also go buy a gift as well to go with the card, and obviously that will help the growth, the profit, and the average order basket inside the business as well grow really good as well, which is great. And in the recent trading update, this is the thing that kind of got me across to buy it because of the recent trading update. Now I would have liked a little bit more information, but the fact that they've seen no weakness at the moment going forward and they're still keeping their expectations, and that's obviously with the whole Royal Mail strike situation as well that's been going on, especially during that Christmas period, looked pretty good. And also you see here that they do expect to go back to revenue growth in financial year 24, with the rate of growth weighted towards the second half of the year. They also said that they had a recent record UK Mother's Day, so that suggests as well that sales are being really strong at the moment going forward. So if Moonpig can get back to 3-4% revenue growth, they start getting back to their old levels of profitability. This company, to me, looks very cheap if they can get back to them levels and they go back to growing, which seems to be happening going at the moment. And that's one of the reasons why I ended up pulling the trigger on this one. Now, the only concern that I did have with the business is the financial health. I thought the financial health was a little bit weak. The reason why is because debt does sit at 229 million, but they do have 41 million in cash. A lot of that debt comes from the recent acquisitions, and this was a big thing holding me back from buying this company. But after looking at the generation of profit they could generate of around 40 million next year, and that the management have been saying that they are prioritising now paying down that debt, it did make me a little bit more confident to go buy some shares, that they are prioritising that and that they should go back to very good generations in profit, and they should be able to pay that debt down a fair amount. The other thing that I did really like that changed recently is that there has been a lot of insider buying, especially when you look at December time, and the CFO and director picked up £57,000 worth of shares on the 14th of December, and then that was followed up by the CEO and director as well, that picked up £114,000 worth of shares inside the company as well, and that was at £1.14, which I thought was very good as well to see. So if this company grows revenue at 3-4% a year, gets back to the old profit levels, I can see this stock heading towards the £2 range, and that's why I picked up some shares in Moonpig, as well as having a expansion into the gift range. A lot of the market still to go for. The movement to more online from the younger generations coming through, and also the fact that they have a lot of repeat business as well, which is a little bit different for a company that is selling cards as well. So that's number one. Number two is MoneySuperMarket.com. So I actually made a video on 2 months ago. I can't believe it was 2 months ago. I was going to say like a month. 2 months ago, on January 22nd, I actually made a video saying I might buy supermarket stock. And since that time frame, I should have bought it. I was messing around. If we actually have a look at January the 22nd here, yeah, the stock is up 17% since that time frame. So I should have really bought it. And eventually I got to the point where I was like, okay, it's up a fair bit. Can I still buy it? And I looked at the numbers and I thought, okay, I'm going to buy it. And you know what? Worst case scenario, if this does drop back down to the £2 range or whatever it is, I don't think we'll go to this low in the Liz Truss time, but let's say we get back down to the £2 range. You know what? I'll just buy more, because I would really like it at them sort of levels. So I thought, I'll just buy and we'll see where we're at. If the share price goes lower, obviously that will be great, and then I can get more upside. So it's a 1.3 billion market cap, so that's a decent size for a UK company. Same again, 19 times earnings. It's a 4.6% dividend yield, so it is paying a dividend at the moment. So Money Supermarket is a comparison site, and I think that these sort of sites are going to do very well, especially if we're in a time frame where money's getting tight. Everyone's going to be trying to save as much money as they can, and something like a Money Supermarket should do well in these environments. You've got the likes of car insurance, credit cards, home loans, travel insurance, which I think could be quite hot going forward, life insurance, mortgage deals, mobile phone. Funny story, when I was actually researching to buy this company and I was doing a few things, I actually had a bit of a go using the website and everything like that. I actually bought a new mobile phone through Money Supermarket, so me actually researching into this company actually made me a customer as well. Pet insurance and broadband deals. And That's where a lot of the income comes from. They also have the likes of money saving expert like Martin Lewis, and they also have a new acquisition which is Quidco, which is like a cashback platform as well, which is a good addition into the portfolio, which I thought will help the company grow going forward. And really the UK is controlled by 4 price comparison websites: Compare the Market, Go Compare, MoneySuperMarket and Confused.com. And it's very hard to kind of break into these 4 and disrupt them really. They've kind of got good control on the market. And that was a prime example when Google actually tried to get into the insurance compare site. And basically after a couple of years they went, yep, this is too hard to do. And they shut it down. And that's Google. You know, a company that you would think would have a good shot at it with already having Google search and the money they have to throw into it. So it does show you there's kind of a bit of a moat or competitive advantage that when you build up to try and disrupt it and get people away from these sites, it's a little bit hard to do. Now, the recent trading update from MoneySuperMarket was actually really good. So this came out on Tuesday the 18th of April, and if you have a look here, insurances was good, up 23%, money was up 9%, home services was up 5%, travel was up 63%, cashback, which is the newest edition, was up 3%, and that gave them total of 15% revenue growth going forward. Now the big thing at the moment is home services is actually one of the biggest parts of the company, but you can see here it's not showing it at the moment. Now the reason why is because this is to do with the energy comparison. Now normally you'd go compare to maybe compare energy providers, but at the moment, because of the whole energy switching market not happening because of the whole energy situation in the UK, they've actually at the moment lost one of their biggest drivers of profit and revenue at the moment. And it probably won't come back this year, but more likely the energy market is going to come back in next year. So you've got a company here at the moment that is offering good amounts of growth at the moment. You're seeing the profit having to be driven down, the revenue driven down by the energy situation here. But the fact that the profit is starting to move back into a positive direction and the revenue is now growing even with this energy situation, and that's one of the biggest contributor of profit and revenue. Going forward, when you add in the fact that the energy market will probably come back in 2024 and the profit will come back in 2024, you're going to be talking about where the company was previously. You know, the company was nearly doing 100 million in profit. The company will probably get back in the next 1 or 2 years when the energy market comes back online. You're talking nearly over 100 million profit, and the revenue as well could be touching up to 500 million as well in the next few years when that energy market comes on, and also because the rest of the business has been performing so well. And then you talk about potentially 100 million in profit at a 1.3 billion market cap. You're talking 13 times earnings for a company that's going to be growing probably high single digit with good amounts of profit and very good profit margins. I think this is an absolute no-brainer. And you look at the financial health of the business, it's very healthy. As you can see here, there's 44 million in debt, 20% debt to equity. But you know, if they go back to generating nearly 100 million in profit, they could pay off that debt in 1 year with that amount of profit as well, which is obviously great. And you look at the dividend as well, that dividend is 100% going to start getting hiked up. It's been a little bit flat recently because of the whole energy situation, but as soon as that energy market goes up, you know, you're going to be talking about a dividend that's easily going to be, you know, collecting 5-6% dividend yield. And especially if you can actually combine that with the fact that, let's say MoneySuperMarket goes back down to £2, that dividend yield's going to be very, very attractive as well as a low times earnings. And same again, you combine that with there's been insiders buying a lot over the November period where the share price created to £1.70, £1.80. You can see here the CEO picked up a ton of shares, 20,000 there, and also the chairman of the board picked up 40,000 shares as well. I just think this is set for a very good 2 years. You know, they've been smashing it without the energy part of the business, and then the energy business comes back in the next 2 years. I just think it's an easy one to understand why this is going to do really well going forward. And on to the third one that might actually surprise a couple of people. I did buy Barclays. I bought Barclays because it was during the whole banking situation where Silicon Valley Bank collapsed. Everyone started worrying, oh, what's going to happen to the banking sector? A lot of the bank stocks sold off, and I thought, okay, you know, Barclays was doing okay around January, February time. That £1.90 dropped all the way down to £1.30, had a bit of a rally up to £1.50, and obviously the dividend yield is around 4% as well. And I thought, okay, you're never going to get crazy share price return from Barclays, maybe 30 to 50% return in the next 5 years, but also collecting a 4-5% dividend yield with a relatively relatively safe and boring company, I thought, okay, we'll just add a little bit of shares in here, and I think it's a good opportunity. It's a very safe bank. It's obviously a worldwide bank. It's never going to have like a bank run like Silicon Valley. Very safely invested its capital. It's more regulated. It's a lot more retail clients as well. And I was looking at it at 4.8 times earnings. Historically, that's quite low. Obviously, it trades at a low value, normally low times earnings of like 6, I believe. But it's a lot lower than a lot of the other banks out here. I was looking at the price to book. I don't know if it's actually got the price to book. Oh, it has. Yeah, there we go. So it's got a 0.4 price to book, and it was once again historically a lot lower than what it normally is. I think it's normally around about a 0.6 or something like that. And once again, it's a lot lower than a lot of other banks in this sort of space. And as long as it can hold revenue and profit quite steady at these sort of rates, which it hasn't done previously, it previously got into a couple of situations which hopefully they resolve a little bit, which did hurt the profitability. But as long as it holds these sort of levels, I think I'll pick up a quite a solid dividend stock here going forward. And hopefully if they hold these sort of levels of profitability, they actually do go on to increase the dividend as well going forward. So I thought this was just not a big position or a crazy position, but just something that just had a little bit of stability in there, especially when the share price has been created and it's trading at a little bit lower metrics than what it normally does. So yeah, I did add a little bit of Barclays in there. And the last one is Forterra. So Forterra, I've had two people basically mention this one to me. The first one was when, you might have remembered at the back end of 2022, we did an interview with the Playing Footsie guys, and Steve mentioned about Forterra, and I thought, oh, it does look quite interesting. And then also on the Patreon, we do a stock request, and on the stock request, basically the members on the Discord put 3 stocks forward, and I have a look into them and say what I think. And I was like, that was the first time I actually did do quite a bit of a deep dive into it. And I was like, this is actually really good. And then since the time frame, since I did start doing that, the share price has then gone down another 14%. And I thought, okay, it's even cheaper now. And the thing that I said would get me over the line if it does go a little bit cheaper and the yield gets a little bit higher. And I thought, okay, that's the what I needed. It's getting towards the levels of the CV times. I think this now justifies me buying this. And obviously there's a lot of negativity priced in because it is involved in the building industry, and what do we know at the moment? Everyone thinks the building industry, well, it is, the building industry and the housing market is getting a little bit weak. But how much is that kind of priced in now was the ultimate question I had. And I feel like there's a lot priced in at the moment. So Forterra, like I said, do a lot of building supplies. You can see here bricks, blocks, roofing, paving. And one of the big things they're well known for is the London brick. They actually manufacture the London brick, which currently holds around 25% of the British brick market, with the production of 1.7 billion bricks per annum. And this is also a little bit of a picks and shovel play where it's not directly like a house builder, but because it has a good share of this market, you're basically getting all the house builders with it because they supply a lot of bricks. And the thing as well with the London brick, by the way, I actually found really random. I was doing some gardening in the other weekend, and I found a brick in the garden, and I picked it up and I went, it's actually a London brick in the garden. So it does show you they're kind of everywhere. So I'm guessing my house is actually made out of London brick. But the other suggestion is that obviously all the house builders use them, so you have that stability that you're not relying on the one house builder. But the other thing is that because you might have your house built by the London brick, if you ever want to have an extension, for example, and you want to match the bricks up, you would then also go back to London brick to have the matching bricks, for example, to build the extension as well. And in a time frame where people might not want to move and extensions might come a little bit popular because it's cheaper to do and you want a bit more space, it also could help you in a downturn environment as well. And the company is making a lot of investments to help with the production. They've been building a lot of new brick factories, as you can see here, and you can see here that they are also in this factory going to increase their brick production capacity by 22% as well. So it looks like, to me, it reminds me of Taylor Wimpey. There was a time in the CV situation where a lot of house builders absolutely, I can't think of a better way to describe them, they were a little bit worried, and I think you know what I was going to say, but I couldn't say it that way. They were a little bit worried and they just stopped. And Taylor Wimpey was one of the house builders that just bought loads of land cheap. And eventually when the CV situation came out, they did really well because they bought all this land for cheap. It looks like to me that Forterra are in a place when we come out of this situation, they're going to have so much production and there's going to be a boom in the housing market once again, that they'll be really well placed for that with the investments that they've just started putting into these new factories. And that's clear when you look at the shortage that we have in houses. The government is aiming to build 300,000 new houses every year, but less than 250,000 were built last year. So that we're way too short. And the big thing at the moment is people aren't buying houses at the moment. So when interest rates do finally go down, and the houses do come cheaper, when the interest rates come down and houses are cheaper, there's going to be such a backlog of people that haven't bought houses in 2022 that when that happens, there's going to be a massive boom. And who's going to be there to supply all the bricks for the new housing boom with the new factory that they've invested in? It's going to be Forterra. And Forterra did recently come off good earnings on the 9th of March, but a lot of this is through 2022. So the slowdown is starting to happen here, which they did say on the outlook. They said that they've seen a fall in demand by 20% compared to 2022. And even though this has only just come out in 2023, we already started to see that priced in. Even though that they've just said that, we saw the fall in demand actually getting priced in 2022. And this is a clear example of that the stock market is always future thinking. The stock market is always trying to think 6-12 months down the line where we're going to be. And you could see that was already getting priced into Forterra around August. So now that we've had a lot of that priced in, and that basically the market knows now there's a 20% fall in demand, is when does the market start pricing in a recovery? Now, obviously, the share price isn't going to go up when the recovery is already obvious. So basically, the market is going to be thinking 6 months before that, when is the recovery going to happen? And I think we could see that at the start of 2024. So I think basically we've got a 6-9 month period here where Forterra will stay cheap, but then when the demand comes back, it should do very well going forward. And that's clearing the same predictions that analysts are thinking. Analysts are thinking that 2023 is going to be a year where it doesn't grow as much, but after 2023, when we move into 2024, we'll start seeing some of the sales come back, we'll start seeing some of the profit come back, and especially in 2025, we'll actually be set for a very good year in 2025. And financial health-wise, you look at the business, very healthy balance sheet, 40 million on debt there, 80% debt to equity. They do generate good amounts of profit as well, so they could pay that off very quickly if they wanted to. And like we said, it does sit on a 7.3% dividend yield. There is forecast that is going to come down, but it's still going to be very high. And then thinking when the housing market does recover, then we should see that come back. But even a 5% dividend yield, 6% dividend yield, I still think that's a very good dividend yield, and I would expect it to recover when the housing market's back as well. So I would not worry about that too much. The only thing I would like to see a little bit is a bit of insider buying. There's not much insider buying going on inside the business. And when your share prices are the levels that it was at basically in the CV situation, and you'd think about all the new investments that are coming in, you'd think that there would be some of the insiders that would pick up some shares. So that was my only criticism of the company anyway. But yeah, that was stock number 4. So a bit of a longer one today, but I know you don't mind it when we do these kind of more deeper dives inside to the company. And it's been a while since we've done a very big deep dive like that one anyway. So it does take a while to put these videos together, but I enjoy them, you enjoy them. And as always, just for me trying to put these videos together and doing it all for free for you guys on the internet, all I ask for is if you could hit that like button, that'd be absolutely amazing. And have a great weekend. Catch you in a bit.